Yo, yes, go. Transfer pricing. Introduction. In the present age, what? In the present age of globalization, multinational companies have branches, subsidiaries, divisions operating in more than one country. There is a possibility that two or more entities belonging to the same multinational group can fix up their prices for goods and services and allocate profits among the enterprises within the group in such a way that there may be either no profit or negligible profit in the jurisdiction which taxes such profits and substantial profit in the jurisdiction where the tax liability is minimum. This results in base erosion of the high tax jurisdiction by shifting the profits to the low tax jurisdiction, thereby minimizing the taxes. This may adversely affect a country's share of due revenue. The increasing participation of multinational companies in economic activities in India has given rise to new and complex issues emerging from transactions entered into between two or more enterprises belonging to the same multinational group. In order to curb such tax avoidance measures, arm's length principle is used intentionally internationally to substitute the transfer price adopted by the MNCs to price the intra-group transfer of goods or provision of services. Generally, the arm's length price refers to the price an unrelated enterprise would be willing to pay in comparable circumstances. The OECD guidelines define the transfer prices as the prices at which an enterprise transfers physical goods and intangible property or provide services to associated enterprises. Two enterprises are associated enterprises if one of the enterprises participates directly or indirectly in the management, control, or capital of the other, or if both enterprises are under common control. Since international transfer pricing involves more than one jurisdiction, any adjustment to the transfer price in one jurisdiction requires a corresponding adjustment in the other jurisdiction. If a corresponding adjustment is not made, double taxation will result. Meaning of arm's length principle. The arm's length principle of a transaction between two associated enterprises is the price that would be paid if the transaction had taken place between two comparable, independent, and unrelated parties. The arm's length principle in the concept of taxation is explained in the OECD Model Tax Convention as under, where conditions are made or imposed between two associated enterprises in their commercial or financial relations, which differ from those which would be made between independent enterprises, then any profit which would, but for those conditions, have accrued to one of the enterprises, but by reason of these conditions have not so accrued, may be included in the profits of that enterprise and taxed accordingly. The OECD transfer pricing guidelines provides guidance on the application of the arm's length principle in order to arrive at the proper transfer pricing range between associated enterprises. Market forces determine business relations between independent parties. The arm's length principle seeks to adjust the profits between two associated enterprises by comparing the same if the transaction is carried out between two independent enterprises. It treats each business separate independent entity rather than as inseparable parts of the single unified business. Significance of arm's length principle. There are several reasons as to why the OECD member countries and other countries have adopted the arm's length principle. Parity between MNCs and independent enterprises. A major reason is that arm's length principle provides broad parity of tax treatment for MNCs and independent enterprises. Since the arm's length principle puts associated and independent enterprises on an equal footing for tax purposes, it avoids the creation of tax advantages and disadvantages that would otherwise distort the relative competitive positions of these entities. The arm's length principle thus promotes the growth of international trade and investment by removing these tax considerations from economic decisions. Second, determines real taxable profits. The transfer price adopted by a multinational has a direct bearing on the proportional profit it derives in each country in which it operates. If inadequate or excessive consideration is paid for the transfer of goods, services, or intangible property between the members of an MNC group, the income calculated for each of those members will be inconsistent with their relative economic contributions. An arm's length price is needed to determine real taxable profits earned in each country. The arm's length doctrine permits the taxing authorities to rectify the accounts of the enterprise so as to reflect correctly the income that the establishment would have earned if they were independent enterprises. Reduction of artificial price distortion. If the arm's length principle is not followed, an MNC will sell goods or provide services to a controlled entity in a high tax jurisdiction at a high price, which exceeds the market price, and to an entity in a low tax jurisdiction or tax haven at a low price, which is lower than the market price. This would result in extreme price distortion of goods and services in the international market. And the final significance of the arm's length principle is that accurate measurement of economic contribution. The arm's length principle provides accurate measurement of the fair value of the economic contribution units of an MNC. The focus of the arm's length principle is to ensure that the proper amount of income is attributed to where it is earned. This results in each unit of the MNC earning a return commensurate with its economic contribution and risk assumed. Next, we move on to the topic of practical difficulties in application of the arm's length principle. First, true comparison difficult in certain cases. The commercial and financial conditions governing a transaction between independent enterprises are by and large never similar to those existing between associated enterprises. As a result, there cannot be a true comparison. The economies of scale and integration of various business activities of the associated enterprises may not be truly appreciated by arm's length principle. Further, associated enterprises may enter into transactions which independent enterprises may not enter into, like, say, licensing of valuable intangible or sharing the benefits of research. The owner of an intangible may be hesitant to enter into licensing arrangements with independent enterprises for fear of the value of the intangible being degraded. In contrast, he may be prepared to offer terms that are less restrictive to associated enterprises because the use of the intangible can be closely monitored. Further, there is no risk to the overall group's profit from a transaction of this kind between members of an MNC. Companies that seldom undertake transactions of the type entered into by associated enterprises may be there may be information and data in order to apply arm's length principle. Regarding the comparable companies, their profit margins, the pricing charged by them in independent and comparable circumstances may be difficult to obtain. Further, the differences in the accounting of the data could result in difficulty as the reliable adjustments may not be possible to be made. Absence of comparable transactions. The arm's length principle reaches a comparable and controlled market price that is reasonably reliable for standard transactions where the price range is narrow and certain. However, the arm's length principle generally fails to achieve a price for transactions involving intangibles because they are unique. The unique nature of these transactions creates a very wide price range. Administrative burden. Due to the subjectivity in selection of comparables and the methods, the application of arm's length principle results in administrative burden for the tax administration as well as for the taxpayers. And the final practical difficulty is time lag. Although an associated enterprise normally establishes the conditions for a transaction at the time it is undertaken, at some point the enterprise may be required to demonstrate that these are consistent with the arm's length principle. The tax administration may also have to engage in the verification process perhaps some years after the transactions have taken place. It may result in substantial costs being incurred by the taxpayer and the tax administration. It is also difficult to appreciate business realities which prevailed at the time when the transactions were entered into. This may lead to bias against the taxpayer. In spite of the practical difficulties listed above, OECD member countries are of the view that the arm's length principle does provide a sound basis to appreciate the transfer pricing between associated enterprises. It has so far provided acceptable situations to both taxpayers and tax administrators. The experience gained so far should be effectively used to remove the practical difficulties and improve the administration. We come to the next topic, which is the Indian scenario. Transfer pricing in relation to international transaction. Finance Act 2001 has introduced Chapter 10 of the Income Tax Act 1961 with a view to provide a statutory framework which can lead reasonable, fair, and equitable profits and tax in India so as to curb the strategies adopted by the MNCs resulting in base erosion and profit shifting. These provisions are contained in sections 92 to 92F of the Income Tax Act 1961. Rules 10A to 10E have been inserted in the Income Tax Rules 1962. These sections and rules of the Income Tax Act 1961 and the Income Tax Rules 1962, respectively, will affect All non-corporate and corporate assessees who have dealings with non-residents for import or export of goods, properties, or services. The following conditions must be satisfied in order to attract the special provisions of Chapter Tech 10 relating to avoidance of tax. There must be an international transaction. Such international transaction should be between two or more associated enterprise, either or both of whom are non-residents. Such sale or lease of tangible or intangible property, provision of service, or lending or borrowing of money, or any other transactions having a bearing on the profits, losses, or assets of such enterprise. Can also involve allocation or apportionment or any contribution to any cost or expenses incurred or to be incurred in connection with the benefit, service, facility provided or to be provided by one or more of the arrangement or agreement between such enterprises. Such international transaction must be done at the arm's length, and if such international transaction has been done at less than the arm's length price, it shall require determination of income or apportionment of cost or expense on the basis of arm's length price. And finally, the above adjustment should either result in an increase of income or decrease of loss returned by the SSC. In other words, the adjustment should not have the effect of reducing the income chargeable to tax or increasing the loss. Computation of income from transaction with non-residents, Section 92. Section 92 provides that any income arising from an international transaction shall be computed having regard to the arm's length price. For this purpose, the allowance for any expense or interest shall be determined on the basis of arm's length price. The section further provides that in an international transaction between two or more associated enterprises and where there is a mutual agreement or arrangement for the allocation or apportionment of any contribution to any cost or expenses in connection with the benefit, service, or facility provided to any of or more of such enterprise shall be determined having regard to arm's length price of such benefit, service, or facility. The objective of transfer pricing provisions is to protect the tax base of India and to ensure that due to intercompany transactions, there is no reduction in the taxable profits or the taxes paid by the Indian taxpayer. It is, however, pertinent to note that be applicable if substitution of the arm's length price has the effect of reducing the income chargeable to tax or increasing the loss. The assessing officer will have wide powers to determine Section 92R associated enterprise associated enterprises. Section A1 defines the associated enterprise generally. Section 92A2 provides 13 relationships between the enterprises which constitutes deemed associated enterprises. The term associated enterprise in relation to another enterprise is defined in Section 92A1. Associated enterprises are those which are owned or controlled by the same or common entity slash person. So, let's say an enterprise which participates directly or indirectly or through one or more intermediaries in management of other enterprise or control of the other enterprise or capital of the other enterprise. Example, let's say where A limited directly participates in the management of B limited and B limited directly participates in the management of C limited. In such situation, A Limited has a direct participation in management of B Limited, but has an indirect participation in management of C Limited. In such a scenario, both B and C would be associated enterprises of A Limited. If one or more persons participates directly or indirectly or through one or more intermediaries in management, control, capital of the two different enterprises, then those two enterprises are associated enterprises. Example, Mr. A directly has control in A Limited and B Limited. In such a scenario, both A Limited and B Limited are associated enterprises since there is a common person, Mr. A, who controls both entities A and B Limited. Two enterprises are deemed to be associated enterprises if they fall under any one or more of the situations contained in Section 92A2. This section provides 13 such situations during which associated enterprise relationship is deemed to be established. Two enterprises are deemed to be associated enterprise if condition enterprise ownership. So what is the situation here? One enterprise holds 26% or more of the voting power directly or indirectly in the other enterprise. Example, A Limited holds 33% of voting power in B Limited and B Limited holds 80% of voting power in C Limited. In the above situation, A Limited holds 26% or more voting power in B directly and in C Limited indirectly through B Limited. Therefore, both B and C are deemed associated enterprises of A Limited. Substantial voting power in two entities by common persons. Any person or enterprise holds 26% or more of the voting power directly or indirectly in each of the two different enterprises. Like say Mr. A holds 40% voting power in both X and Y Limited, where neither X has any holding in Y nor Y has any holding in X. In this situation, since Mr. A directly holds 40% of the voting power in both X Limited and Y Limited, X Limited and Y Limited will be deemed associated enterprises. Advancing of substantial sum of money. One enterprise advances loan to the other enterprise of an amount of 51% or more of the book value of the total assets of other enterprises. Book value of total assets of Y Limited is 5 crores. X Limited advances loans of 60 crores to Y Limited. In this case, X Limited advances loans of 60 crores to Y Limited, which is 60% of the book value of total assets of Y Limited. Hence, X and Y are deemed associated enterprises. Guaranteeing borrowings. One enterprise guarantees 10% or more of the total borrowings of the other enterprise. P Incorporated has total loan of $1 million from XYZ Bank of America. Out of that, A Limited, an Indian company, guarantees 20% of total borrowings in case of any default made by P Incorporated. In such case, A Limited guarantees 20% of total borrowings of P, and A are deemed associated enterprises. Appointment of majority directors of other enterprise. One enterprise appoints more than half of the board of directors or members of the governing board, or one or more executive directors or executive members of the governor board of the other enterprise. X Limited has 15 directors on its board. Out of that, Y Limited has appointed 8 directors. In such case, X Limited and Y Limited are deemed enterprises. Appointment of majority of directors of two different enterprises by same persons. More than half of the directors or members of the governing board, or one or more of the executive directors or members of the governing board of each of the two enterprises are appointed by the same persons. Example: Mr. A appointed 9 directors out of the 15 directors of X Limited and appointed two executive directors on the board of Y Limited. In such a case, since a common person A appointed more than half of the directors and appointed two executive directors in Y, both an X and Y are deemed AEs. Dependent enterprise has exclusive rights. Of goods or articles or business carried out by one enterprise is wholly dependent 100% on the know-how, patents, copyrights, trademarks, licenses, franchises, or any other business or commercial rights of similar nature, or any data, documentation, drawing, or specification relating to any patent, invention, model, design, secret, formula, or process of which the other entity is the owner or in respect of which the other enterprise has exclusive right. Dependence on raw materials supplied by other enterprise. 90% or more of the raw material and consumables required for the manufacture or processing of goods or articles carried out by one enterprise are supplied by the other enterprise or by persons specified by the other enterprise, where the prices and other conditions relating to the supply are influenced by such other enterprise. Dependence on sale. The goods or articles manufactured or processed by one enterprise are sold to the other enterprise or to persons specified by the other enterprise, and the prices and other conditions relating thereto are influenced by such other enterprise. Controlled by common individual. Where one enterprise is controlled by an individual, the other enterprise is also controlled by such individual or his relative, or jointly by such individual and his relatives. Mr. A and B are relatives. Mr. A has control over X. Mr. B has control over Y, therefore both X and Y will be deemed AEs. Controlled by HUF or member thereof, where one enterprise is controlled by a HUF and the other enterprise is controlled by a member of such HUF or by relative of a member, and such HUF or jointly by such member and his relative. Okay, HUF controls, fine. This interest in a firm, AOPs or BOIs, whether where one enterprise is a firm, AOPs or BOIs, the other enterprise holds 10% or more interest in firm, AOPs or BOIs. Mutual interest relationships. There exists between the two persons in a relationship of mutual interest as may be prescribed. The term enterprise is defined in section 92F to mean a person, including its certain specified permanent establishment, who is or has been or is proposed to be engaged in any activity relating to the production, storage, supply, distribution, acquisition, or control of articles or goods or know-how, patents, copyrights, trademarks, licenses, franchises, or any other business and commercial rights of similar nature, or any data, documentation, drawing, or specification relating to any patent, invention, model, design, secret formula, or process of which the other enterprise is the owner on, in respect to which the other enterprise has exclusive rights, or the provision of services of any kind, or in carrying work in pursuance of a contract, or in investment, or providing loan, or in business of acquiring, holding, underwriting, or dealing with shares, debentures, or other securities of any body corporate. Whether such activity or business is carried on directly or indirectly through one of or more of its units, divisions, subsidiaries, or whether such unit or division or subsidiary is located at the same place where the enterprise is located at a different place or places. Permanent establishment includes a fixed place of business through which the business of the enterprise is wholly or partly carried on. Okay, we'll keep it up till here and cover the next part in another stream.